47 million ounces. Gone. Vanished. In 72 hours. Not slowly drained over months, not gradually moved over weeks. Disappeared from COMEX vaults between Friday close and Monday open, while the entire financial world was looking the other way. That is $1.5 billion in physical silver that was sitting in the most secure vaults in America. And now it is not there anymore. The COMEX is not some obscure warehouse. It is the central nervous system of the global precious metals market. Every price you see for gold and silver on your phone, on CNBC, on your trading platform, that price comes from COMEX. And right now, the vaults that are supposed to back those prices are hemorrhaging metal at a rate that has never been seen in the 90-year history of the exchange. They do not want you to see this. The mainstream financial media has not said a word. No headlines, no alerts, no breaking news banners. Because if the public understood what just happened, there would be panic. There would be bank runs on metal. And the entire paper precious metals market would collapse overnight. Let me show you exactly what happened, where the silver went, who took it, and what this means for every ounce you think you own. Before I show you the evidence, you need to understand what the COMEX actually is and why this disappearance matters. Because most people have no idea how the precious metals market really works. They think it works like the stock market. It does not. It works like a casino where the house can change the rules whenever they want. COMEX stands for Commodity Exchange. It is owned by the CME Group, the Chicago Mercantile Exchange. It is where futures contracts for gold, silver, platinum, and palladium are traded. When a major bank or hedge fund wants to buy or sell large quantities of precious metals, they do it on the COMEX. Here is how it is supposed to work. A futures contract is a promise to deliver a certain amount of metal at a certain date in the future. If you buy a silver futures contract, you are buying the right to receive 5,000 ounces of silver at a specified price on a specified date. The seller is promising to deliver that silver. To back up those promises, the COMEX maintains vaults in the New York area. These vaults are supposed to hold physical metal that can be delivered against contracts. The metal is categorized in two ways: eligible and registered. Eligible silver is metal that meets COMEX specifications for purity and bar size. It is sitting in the vault, but the owner has not made it available for delivery. Think of it as silver that is parked there for safekeeping. The owner could use it for delivery, but they have not committed to doing so. Registered silver is different. Registered silver is metal that has been specifically earmarked for delivery against futures contracts. This is the silver that is supposed to back the paper promises. When someone stands for delivery, they get registered silver. Now here is where it gets interesting. The registered silver inventory has been collapsing. In 2021, registered silver stood at over 150 million ounces. Today, it is approximately 45 million ounces. That is a 70% decline in less than 4 years, and the pace is accelerating. But what happened this week was not normal decline. It was not gradual drainage. It was a sudden, massive, coordinated exodus of metal from the vaults. 47 million ounces moved in a single weekend. And the question that nobody is answering is, where did it go? Let me walk you through the numbers, because I want you to see this with your own eyes. The CME Group publishes daily vault reports. They show exactly how much metal is in each vault and how much is registered versus eligible. These reports are public. You can download them yourself, but nobody in the mainstream media reads them. That is why I do. On Friday, the total COMEX silver inventory stood at 291 million ounces. By Monday, it was 244 million ounces. That is a drop of 47 million ounces in a single weekend. To put that in perspective, global silver mine production is approximately 820 million ounces per year. That is about 2.25 million ounces per day. What left the COMEX in 72 hours is equivalent to 21 days of global mine production. 3 weeks of the entire world's mining output vanished from one vault system in one weekend. This was not a normal delivery. Normal deliveries happen during the delivery month when contract holders stand for physical metal. Those deliveries are scheduled. They are expected. They are measured in hundreds of thousands of ounces, not tens of millions. What happened this week was a warrant cancellation event. Let me explain what that means. When metal is registered for delivery, it has a warrant attached to it. A warrant is a document that proves the metal is available for delivery. When someone takes delivery, the warrant is canceled and the metal leaves the registered category. But here is the key. The metal does not have to leave the vault when the warrant is canceled. It can simply move from registered to eligible. It stays in the vault but is no longer available for delivery. That happens all the time. What happened this week was different. The metal did not move from registered to eligible. It left the vault entirely. Physical silver was loaded onto trucks and transported out of COMEX facilities. 47 million ounces, gone. The vault reports show which vaults were affected. JP Morgan's vault lost 12 million ounces. Brink's lost 15 million ounces. Delaware Depository lost 8 million ounces. HSBC lost 7 million ounces. Loomis lost 5 million ounces. This was not isolated to one vault. This was a coordinated withdrawal across every major COMEX depository simultaneously. Someone with massive resources, someone with logistics capabilities, someone with a very specific plan moved 47 million ounces of silver out of the American financial system in 72 hours. And they did it while nobody was watching. Where did it go? 10 ink to 15 DAO. So where did the silver go? This is where it gets interesting. Because silver does not just disappear, it has to go somewhere. And when you track the logistics, when you follow the shipping manifests, when you analyze the timing, a picture emerges. A disturbing picture. There are only a few possible destinations for 47 million ounces of silver leaving the COMEX. Possibility 1. Domestic industrial users. American companies that need silver for manufacturing. Solar panel producers. Electronics manufacturers. Medical device companies. These users consume silver every day. But here is the problem. Domestic industrial demand is approximately 150 million ounces per year. That is about 12 million ounces per month. 47 million ounces in one weekend is 4 months of domestic industrial demand. That does not make sense. No industrial user would take delivery of 4 months of inventory at once. The storage costs alone would be prohibitive. This was not industrial consumption. Possibility 2. The London Bullion Market Association. The LBMA operates vaults in London that hold silver for international trade. Sometimes metal moves between COMEX and LBMA as arbitrage opportunities arise. If silver is cheaper in New York than in London, traders move metal east. If it is cheaper in London, metal moves west. But 47 million ounces is an enormous arbitrage trade. That would require a price differential that did not exist. Spot prices between COMEX and LBMA were within normal ranges. This was not arbitrage. Possibility 3. Exchange for physical transactions. EFP trades allow large holders to swap futures contracts for physical metal outside the exchange. These transactions happen in the dark. They are not reported publicly. They do not hit the visible market. EFP volume has been exploding in recent months. According to data from the CME, EFP transactions have tripled compared to the same period last year. Someone is using EFP trades to quietly accumulate physical metal without moving the spot price. But even the elevated EFP volume does not explain 47 million ounces in one weekend. Possibility 4. And this is where the evidence points. China. The Shanghai Gold Exchange operates the largest physical silver market in the world. Unlike COMEX, which is primarily a paper market, Shanghai is primarily a physical market. Delivery rates in Shanghai exceed 90%. When someone buys silver in Shanghai, they actually take the metal. China has been importing silver at record rates. In 2024, Chinese silver imports exceeded 200 million ounces. That is 25% of global mine production going into one country. And those imports are not coming back out. China is stockpiling silver for industrial use, for solar panel production, for electronics manufacturing, for strategic reserves. The timing of this COMEX drain coincides exactly with shipping schedules from New York to Shanghai. Container ships leaving Newark take approximately 35 days to reach Chinese ports. A shipment leaving this weekend would arrive in early June. That aligns perfectly with Chinese industrial demand forecasts. But here is the part that should alarm you. China is not just buying silver. China is draining silver from the Western financial system. They are converting paper claims into physical metal and moving it beyond the reach of American authorities. Once that silver is in Shanghai, it is not coming back. It is gone from the Western supply chain permanently. This is not a trade. This is a strategic acquisition. China is preparing for a world where they control physical commodity supplies and the West is left holding paper promises that cannot be redeemed. Now you might be thinking, John, I do not trade futures. I do not own a COMEX contract. I just have some silver coins in my safe. Why should I care what happens in New York vaults? Because the COMEX price is your price. The spot price you see quoted everywhere, the price dealers use to set premiums, the price mining stocks are valued against, that price comes from COMEX. If the COMEX loses credibility, if the COMEX cannot deliver metal, if the COMEX becomes an empty shell trading paper with no backing, the entire pricing mechanism for precious metals collapses. Let me explain what happens next. Stage 1. Inventory continues to drain. If 47 million ounces can leave in one weekend, the remaining 244 million ounces can leave in 5 more weekends. At the current pace, the COMEX could be completely drained within 60 to 90 days. Stage 2. Delivery failures begin. When registered inventory gets critically low, the COMEX will face a choice: either halt trading or settle contracts in cash instead of metal. Cash settlement means you bought a silver contract, but you get dollars instead of silver. The exchange decides the price. You have no option to demand physical delivery. Stage 3. Paper price and physical price diverge. When the COMEX can no longer deliver, the paper price becomes fictional. Dealers who actually have physical metal will charge whatever the market will bear. Premiums that are currently $5 to $8 over spot will explode to $50, then $100. Then there will be no spot price at all. Just a physical price that bears no relationship to what CNBC shows on screen. Stage 4. Supply chain breakdown. Industrial users who rely on COMEX for their silver supply will face shortages. Solar panel production slows. Electronics manufacturing delays. Medical devices become scarce. The economic disruption ripples through every sector that depends on silver. This is not hypothetical. This is the trajectory we are on. The 47 million ounce withdrawal this weekend accelerated the timeline dramatically. We are now months away from a potential COMEX failure, not years. And if you think the exchanges will warn you, if you think they will announce that they are running out of metal, you are mistaken. They will maintain the illusion until the last possible moment. They will keep trading paper contracts until someone actually stands for delivery and finds an empty vault. By then, physical silver will be unavailable at any price. Dealers will be sold out. Premiums will be astronomical. And the people who did not prepare will be left holding paper claims on metal that does not exist. Let me zoom out and show you how this connects to everything else we have been tracking. Because the COMEX drain is not an isolated event. It is part of a larger pattern, a pattern of physical assets leaving the Western financial system and moving east. The same thing is happening in gold. COMEX gold inventory is down 35% from its 2021 peak. London Bullion Market Association gold inventory is at multi-year lows. Central banks, particularly China, Russia, India, and Middle Eastern nations, are buying gold at the fastest pace in 50 years. The same thing is happening in commodities broadly. Copper inventories are at historic lows. Lithium supplies are constrained. Rare earth elements are controlled almost entirely by China. The West is discovering that decades of financialization, decades of trading paper instead of accumulating physical assets, has left us vulnerable. This is economic warfare. China and Russia have studied American power. They understand that American dominance rests on the dollar and on control of financial markets. They understand that the way to defeat America is not with missiles, but with math. Drain the physical assets. Force the paper system to break. Watch the confidence collapse. The 47 million ounce silver drain this weekend is a battle in that war. It is China and their allies systematically removing the physical backing from Western financial claims. Every ounce that leaves the COMEX weakens the credibility of the paper market. Every ounce that arrives in Shanghai strengthens China's position in the global economy. We are watching a transfer of wealth, a transfer of power, a transfer of the physical resources that actually matter. And it is happening while most Americans have no idea. The mainstream media will not tell you. The Federal Reserve will not warn you. The government will not protect you. They are all pretending everything is fine while the vault's empty and the paper claims become worthless. Only those who understand what is happening, only those who hold physical metal outside the paper system will preserve their wealth through what is coming. So, what do you do with this information? Because knowledge without action is useless. Here is the practical framework. First, understand that time is running out. The COMEX drain has accelerated dramatically. What was a slow leak is now a flood. The window to acquire physical metal at reasonable prices is closing. Every day you wait, the risk increases that you will not be able to get metal at all. Second, prioritize physical over paper. Do not buy SLV. Do not buy futures contracts. Do not buy unallocated accounts. These are paper claims on metal that may not exist. When the system breaks, paper holders will receive cash settlements at prices decided by the exchanges. Only physical holders will have actual metal. Third, take delivery. If you own paper claims, convert them to physical now. If you have silver in a dealer's vault, consider taking possession. If you have allocated storage, verify that your metal actually exists and that you can access it during a crisis. Here is how to position based on your resources. If you have $100, buy 3 to 4 ounces of physical silver, 1 ounce rounds or pre-1965 US quarters and dimes. These are recognizable, divisible, and liquid. Store them at home in a secure location. If you have $1,000, buy 30 ounces of silver, mix of 1 ounce rounds and a 10 ounce bar. Consider adding 1/10 ounce of gold for diversification. Home storage in a quality safe. If you have $10,000, buy 200 to 300 ounces of silver and at least 1/4 ounce of gold. Diversify your storage. Keep some at home. Consider a private vault outside the banking system. Do not put all your metal in one location. If you have $50,000 or more, build a comprehensive position. 500 to 1,000 ounces of silver, 5 to 10 ounces of gold. Consider allocated storage in multiple jurisdictions: Singapore, Switzerland, and domestic private vaults. Work with a trusted dealer who has physical inventory, not paper claims. Fourth, buy consistently. Do not try to time the market. Dollar cost average. Buy every month regardless of price. The fundamentals are overwhelming. Short-term price movements are noise. Accumulate steadily and do not stop. Fifth, ignore the paper price volatility. When the banks want to shake out weak hands, they smash the paper price. The algorithms dump contracts. The price drops. Scared people sell their physical metal at a loss. The banks buy it at a discount. Do not be that person. Hold your physical metal. Ignore the CNBC ticker. Your ounces are still your ounces regardless of what the manipulated paper price says. Sixth, monitor the COMEX reports. I track the vault data every day. When I see major movements, I share them on this channel. Subscribe and turn on notifications so you do not miss critical updates. The next 47 million ounce drain could happen at any time. The next one might be the one that breaks the system. 47 million ounces vanished this weekend. The COMEX is draining at record speed. China is stockpiling while the West is left holding paper, and almost nobody in the mainstream media is saying a word. But the COMEX drain is just one piece of a larger puzzle. There is a specific event on the calendar that could trigger the final collapse of the paper silver market. It happens every quarter. It is called the delivery month. And the next one is the most dangerous in years. I break down exactly what to watch for and when to expect the breaking point in this video right here. Click it now. This information will not be available forever. I will see you there.